2022 saw the end of the longest bull market in history, 144 months of almost unbroken gains from March 2009 until the end of 2021. The S&P 500 went from 683 points in March of 2009 to 4,766 on the last day of 2021. Okay, there was a dip in 2020 from a small global event that happened, but come on, that was hardly a crash. Now, as we all know, what goes up must come down, and 2022 showed investors that nothing can last forever. Markets had their worst year since the global financial crash, and almost nothing was safe. The bears said that there was more to come and the worst was still ahead.
I still believe that we're in a bear market and it's going to go lower.
And the bulls said that this was a great time to buy.
Or more, yeah. I mean, I think there's even a chance that we could be, close to 5,000.
Right now, just over halfway into 2023, the S&P 500 has been on a tear, up over 18% year to date, giving it its best ever start to the year. We're now just around 4% away from the market touching all-time highs again, and it's making a lot of people nervous. So that's why I wanted to take a look and answer the question, is the S&P 500 in a bubble again? And maybe more importantly, what can we do about it as investors? Okay, let's take a breather. 2023 has been a pretty crazy start for investors, as there's been so many green days that even Barbie is now considering whether pink was the best color choice. Did you know that they actually caused a pink paint shortage making that movie? Anyway, while the bears have been licking their wounds and questioning their life choices, investors have been seeing massive gains in just a few months of trading. Big names like Tesla are up 168%, AMD is up 84%, and leading the charge is Nvidia at a whopping 224% year to date, taking it to a market cap of over $1 trillion. Now, when prices rise in such a short space of time, it does tend to make a lot of people nervous. And right now, I think we can all agree that AI is all the rage. So if you have anything to do with artificial intelligence, even remotely, the market just presses buy. In fact, I bet if I just say the word AI 3 times in a row, I'll get 10,000 more subscribers on my YouTube channel. Hint, it's the little red button below. We'll return to AI a bit later. Right, looking at the numbers then, how do things look right now in terms of prices? What does the data say? If we look at popular measures like the Shiller PE ratio, here is where things stand right now. Now, as of time filming this video, the Shiller PE is 31.5. Remember that this means that you need $31.50 to pay for every $1 made in company profit. The higher the number, the more expensive those profits are. So typically a low number here should mean that things are cheaper, at least from a historical point of view. Now, many people like to use this number and compare it to the past, as on its own, it's not really that useful. Now, the long-term average, if we go back more than a century, is just 17. So at first look, we might think, okay, we're heading to almost double a long-term historical average. Better get on the brakes and stop investing, things are getting pretty crazy. However, although that all might make perfect sense, you have to be really careful how you use this and how far back you want to go. You see, the stock market of the 1920s, the 1930s, the 1990s, and even the 2000s are all very, very different. You're not comparing the same companies, the same industries, and the world has changed so much. If I just take one point, how about we look at profits from the past? How many dollars have we earned per share throughout the past? Now, since the early 1990s, here's a chart showing the S&P 500 price growth in blue, and then on this other line in this orange color is earnings per share. Now, as you can see, these two track each other really closely, and we've gone from around $20 a share earned when the market was at 500 to today now around $180 per share when the market price is around 4,500 points. Seems like a fair trade-off then. We have to pay more, but then we're also getting companies who make more profit in percentage terms as well. Now, if I quickly just grab this graph from Yardeni Research, here's how the operating profit of all the companies in the S&P 500 have changed over time, at least from 1994. As you can see, we've gone from around 6% to 12%, meaning that companies are making twice as much profit than they used to. And it's no surprise when you look at the companies who now make up a large part of the stock market, as they all sell high profit margin products like software and services, which is just a world away from companies just a few decades ago who used to be on top. So therefore, it makes sense that people are willing to pay more, pushing those valuations up a bit higher. Still though, even with this little deep dive into past data, it doesn't tell us about whether or not the market is overvalued right now. How do we know if the money we invest today has a good chance to grow? Now, funny enough, as I was making this video, I got this email from Nick Majuli, who writes an awesome blog called Of Dollars and Data. And the title was The Problem with Valuation. Perfect timing, I thought. Definitely worth a read and a subscribe as it's totally free. But let me pull out a couple of really interesting bits for you now. So let's say that we do invest now and we know that things might look a little expensive. what does history tell us about what the future returns might be? Now this graph might look a little complex, let's just talk you through it. What this shows is the expected return over the next 10 years based on the starting PE of the US stock market. So on the y-axis, you have your investment, $1 being that baseline, and then the x-axis going left to right is the PE of the market when you make that investment. Now all of the little dots represent what actually happened over a century. So quick example, let's say that we invested with a PE of 20 into the stock market. As you can see, our returns could have been anything from almost turning every dollar into $4 or even losing money as shown by these red dots. Another example might be to say that anytime the stock market had a PE of 10 or less, there's never been a time that the next 10 years you would have lost money. But still, the dots are all over the place, so really we have no idea what could happen. Now let me just improve on this for a second. So Nick's provided these charts on the blog post and he's kindly added a line of best fit for a trend line and popped this little red triangle showing where we are now. Now looking at this would suggest that any investors right now are likely to only maintain the value of their investment over the next 10 years, matching inflation. So surely this can't be good, we better stop investing completely, sell everything and wait until the PE of the market is lower then. I wonder what Nick made of this data in his own conclusion. He says, and I quote, "Nevertheless, this simple valuation model has the same flaws that all the others do. It assumes that underlying conditions are the same in every time period. It assumes that a PE ratio of 15 in 1940 is identical to a PE ratio of 15 in 2009. But as I've just demonstrated, they aren't. They may look the same, but they definitely don't feel the same. So in other words, nobody knows and it's anyone's guess. If there was a simple way of knowing what the future returns of the stock market might be, then everything would already be priced into the market and there would be very little returns to be had." Jumping over to the dark side for a second, there are and probably always will be many of those who are keen to point out the market downsides and convince you that the market is overpriced and ready to burst. Funny enough, being consistently bearish does get a lot of airtime in the stock market news, and let's not forget how people here on YouTube love a good flaming background and Jerome Powell with red eyes. However, let's be real for a second and just head back to the topic of AI. Now there's no doubt right now this area of the market is being hyped up massively, and over the last couple of months, even anything remotely involved in this space has seen their share price get a huge bump. Nvidia is the flagship, and as I said at the start of the video, its share price is now up over 220% just since the start of the year. There's no doubt the company has done really well, it's very profitable and has a great future ahead. However, just on a very basic level, it's now trading at a price to sales of 44, meaning that you have to pay $44 for a single $1 of revenue, let alone profit. And then from a profit perspective, even looking forward, the PE ratio is nearly 50. Now, in my view, they're going to have to execute their plan pretty perfectly, otherwise I think a lot of people might end up getting burnt and taking a lot of retail investors down with them. However, even saying that, it's up to the market to decide, so let's wait out and see how things play out. Now, just on that topic of hype cycles, the AI sector reminds me a lot of what happened during the dot-com bubble. Now, I wasn't around to invest during that period, but from my reading and research, there is a lot of similarities that might be able to give us an important lesson. Now, clearly, we know that the internet has had a huge impact on the world and in business from where we're sat in 2023. So the hype around .com was real. However, what none of us can know is which companies will be the ones to survive and who will take the crown. There's a tale of two companies from the .com bubble and it tells this story perfectly. You have Amazon.com and Pets.com, and only one survives today, no prizes for guessing. But just quickly, Pets.com was going to be this online pet store that got a huge amount of funding, raised millions of dollars and even getting an investment from Amazon itself, yet it failed just 9 months after its IPO. It struggled to figure out how to ship items to people like heavy dog food and toys and still make a profit when people could just turn up to a store and get the same thing even quicker. Now, funny enough, Amazon's business model is exactly that, but they managed to survive and completely change the world of online retail. But there's so many stories like this where the industry does well, yet the companies inside the industry only have a few winners. And picking those winners is extremely difficult. Now, you'll often hear that during the dot-com bubbles bursting, Amazon's share price dropped massively. To be honest, that's a bit of an understatement. It went from $113 in 1999 to $5.51 in late 2001. That's a drop of 95% in share price. Will AI have a similar story? Probably, yeah, but who the winners will be? It's anyone's guess. But is the market overvalued right now? That's what we want to know, right? Because if we save our money now and wait for it to get cheaper, we should be able to make more money in the future. I mean, common sense, it's easy just to wait for the right time in the stock market. Or is it? I think a better question might be, what would you do if someone could tell you that with certainty the stock market is overvalued right now? How would that change your behavior? You see, I think what we decide to do with that information is more important than the information itself. First things first, it all depends what your goals and timescales are. Is the market overvalued for 2023 and next year? Maybe, who knows? Is it overvalued for a long-term investor who doesn't need their investment for the next 10 years or more? Unlikely, to be honest, but again, we don't know the future. And then as a follow-up, if you are a long-term investor in this market, you know that sometimes you'll have to invest when times are tough, and sometimes you're going to have to invest when things are looking really good. Funny enough, another great little email I received when making this video was from Andrew Craig, author of the book How to Own the World, which sits just above you, behind you there on my bookshelf. His email title really nails this subject well. It says, "Pessimists sound smart, optimists make money." That's a really good reminder that in the long term, the stock market has been the best wealth building tool that we've ever known. Yet, even with centuries worth of data showing us just how good long-term investing can be, so many people still think investing is like gambling. And probably a key point in the email worth touching on, but it's worth a full read, is that all those people who claim to know that the market is about to crash or the worst is still yet to come always get so much airtime because, unfortunately, our little chimp brains are wired to focus on the negative. And even though there are plenty of bad things to focus on, let's not pretend otherwise. Look at how the world's pulled through all of the events over the past few hundred years and the incredible achievements that have led us to where we are now. It's easy to forget that when all the focus is on high inflation, cost of living crisis, a mortgage fiasco and so on, all valid issues, but just zoom out for a moment and try to think long term. Trying to time the market is a fool's game. You don't need me to tell you that. You don't see Warren Buffett just selling his entire holdings in Berkshire Hathaway and saying, "Guys, I'm going to wait in cash until the next market crash," nor any major successful investor managing money today. In fact, they often tell the opposite story. I mean, Peter Lynch is a great example when he says that more money's been lost trying to predict crashes and corrections than would have been lost if they just sat through them. You see, the problem is once you start asking the question if the market is expensive or not, then you fall into the trap of timing the market because now you have other problems to think about. Do you stay in cash or bonds? What if the market keeps going up and you miss out? What's the opportunity cost of you waiting around? And how will you know when to finally make the investment? Another thing, as a long-term investor, you don't have to get this investing thing right only once. You get many, many times to do this. It's not like when you turn 18, you get all of the money you're ever going to earn in the future and get told, "Right, Sonny, you better get this investment right or you'll end up like that bloke from EastEnders."
I've got nothing left.
Sorry, that meme is just too good. I will not be told I can't use it again. In my view, it's just some random guy on YouTube. One of the greatest tools I think we have is to dollar cost average over a long period of time using low-cost, broad market index funds. The moment we try and start to time the market, guess the moves and trade in and out is the moment that we end up like the rest of the retail investing world who consistently underperform the market year after year. Let's just say the market is overvalued right now, and we did start our investing journey with our first amount into the stock market. Over many more years and many more months, that first investment will be such a tiny amount of money that it really won't matter. Even if you say put in £1,000 or $1,000 and the market drops by 20%, but then you did the same amount investing every month. Eventually the pricing evens out and you get a lower average cost. So what's more important then? Trying to focus on whether the stock market is overvalued based on a future which is unknown, or trying to control what we can as investors, sticking with the plan and taking our emotions out of it. So look, the market could be overvalued or undervalued. At any point, you can find arguments to justify any position, and the end result is the market. The price will reflect where we are right now. Personally, if you want my view as some random guy on YouTube, I tend to ignore all of the news when it comes to deciding what to do with my investments, and I carry on with the plan as I'm a long-term investor who wants to build wealth over the next few decades. But I totally get that your position might be different and we're all unique, so what you decide to do is up to you. Now, on that note, I've got two directions you can go down now. For brand new investors, I have a complete guide for investing which you might like, or as a second option, another really popular one I did recently, should you buy the S&P 500 or a global index fund? This video might help you to decide what the best route is to go. Anyway, as always, thanks for watching and happy investing.